Good morning, everyone, and thank you for taking the time to watch our Fiscal 16 results presentation. Before Kathy and I dive into the results, I want to take a few moments to remind you of our strategy, our performance ambition, and how we measure progress, and then you will have a stronger framework as you review our results. Our strategy is simple. We will increase spirits participation in emerging markets and support premiumization in developed markets. We deliver our strategy through our 6 priorities. These are supported by our talent agenda and the positive contribution we make to the role of alcohol in society, to the communities we are part of, and the way we manage the impact we can have on the environment. Our longer-term ambition is clear: to be one of the best performing, most trusted and respected consumer product companies in the world. We measure our progress through the 4 areas shown on this slide: efficient growth, value creation, credibility and trust, and motivated people, with KPIs aligned to each. So with that as context, let's look at our Fiscal 16 results. They represent more than the good set of numbers you saw in our release this morning. They are about delivering the goals we set for the year. Volume growth was up 1.3%, and our top line grew 2.8% for the full year, with momentum building in the second half. We returned our US spirits business to growth. We expanded margins for the 5th successive year, investing for growth while driving out cost. Cash was up again, and we have momentum. This is a great way to start Fiscal 17. Our Fiscal 16 performance came from strong execution. It is the result of the changes we made. The consumer is at the heart of our business. We have called it sell-out versus sell-in, but it is about the consumer being at the heart of our decisions. We have a more agile organization, accountable and with high performance standards. We measure, we review, we act like owners. To support this, in the last 3 years, we put new leaders in over half of our top management positions. In addition to delivering our goals in Fiscal 16, we also returned our global giants to growth and achieved a significant improvement in the performance of our Scotch and beer portfolios. We focused the portfolio on our core assets and generated over £1 billion of disposal proceeds. We delivered the target set in our January 2014 Global Efficiency Program for £200 million of cost reduction, while moving to new ways of working to deliver our productivity goal of £500 million. Cash conversion was over 100% as we embed efficiency into all of our investments. We enter Fiscal 17 in a good position. It underpins the objective we have for mid-single-digit top-line growth and 100 basis points of margin improvement from Fiscal 17 to Fiscal 19. Now, Kathy is going to take you through the results in more detail, and later I will talk about our focus areas for Fiscal 17 and our 6 priorities.
Thank you, Ivan. I'm now going to look in a bit more detail at what is, as Ivan said, a good set of results with better top-line performance, margin expansion, and increased cash flow. Volume grew 1.3%, and we were up 2% in the second half. Net sales value grew 3%, with 4% growth in the second half. We have sustained positive price mix, driven mainly by mix, given the weaker pricing environment globally. Organic operating margin was up, driven by gross margin expansion and marketing spend efficiencies. This was partially offset by the cost of increased marketing activity and higher overhead costs, mainly on bonus, on improved performance, and inflation given our emerging market exposure. £2.1 billion of free cash flow was up £134 million in the year, reflecting our focus on cash conversion and efficient investment. EPS pre-exceptionals was up 1% as organic profit growth, higher associates income, and lower finance charges more than offset the impact of exchange and disposals. and we've increased the dividend by 5%, in line with our policy to stabilize and rebuild cover. All good numbers, so let me take you through them in more detail. First, I'll cover the items that impacted reported net sales. We have completed the disposal of non-core assets and have a stronger, more focused portfolio. The consolidation of USL beginning in fiscal 15 contributed to our reported top-line growth that year, and in fiscal 16, disposals reduced net sales by £400 million. The disposals included the sale of Gleneagles and Bushmills in the second half of last year, the sale of our beer assets in Jamaica and Malaysia in the first half of this year, and the sale of our wine business in the second half of this year. This was partially offset by net sales from acquisitions of £90 million, which includes gaining the full ownership of Don Julio as part of the Bushmills transaction. The FX impact on Diageo's P&L has eased. Over the course of fiscal 16, weaker emerging market currencies and a weaker euro were partially offset by the appreciation of the US dollar. I'll walk through more detail on foreign exchange a bit later in the presentation, including the expected positive impact from the weaker pound post the Brexit vote. In our Asia business, Diageo has reflected the full-year impact of an accounting change USL has made in its fiscal 17 first quarter results, which is our fiscal 16 fourth quarter. The change reclassifies duties for third-party manufacturers, reducing both net sales and cost of goods sold. It has no impact on profit. What I'd like to focus on now is a deep dive into the drivers of the 3% improvement in organic net sales growth versus last year, with all of our regions delivering improvement. The return to volume growth in fiscal 16 was a key driver fueling our top line, with improved volume growth in all regions and a significant turnaround in U.S. spirits. Price mix was 1.5 points, slightly ahead of last year, with only modest pricing gains. In the second half, we had the benefit of positive market mix, as North America and Europe grew ahead of the rest of the business. You can see momentum picked up in the business in the second half, reflected in better volume and net sales growth. The work we have done expanding our distribution reach, strengthening our big brands through better marketing and innovation, and upweighting recruitment efforts were the key drivers of volume improvement across all of our regions. Our distribution changes range from increasing our sales force by 35% in Europe, almost doubling the number of outlets we call upon, to work with our distributors in emerging markets like Colombia, where we have grown our distributor network to ensure we have the scale to deliver on our mainstream spirits agenda. In Kenya, we are investing in our distributors' sales capability with training and support to improve their efficiency and increase our trade coverage. Our results clearly demonstrate the impact. By region, North America and Europe, Russia, and Turkey were the biggest contributors to growth. Getting North America back to solid growth contributed almost 1 percentage point to Diageo's overall growth rate of 2.8%. North America has now transitioned to the replenishment system for innovation, and for the full year, shipments and depletions were broadly in line. As a result, we expect more stable growth rates in fiscal 17. If we look at our performance by developed and emerging markets, we see a consistent performance with both growing net sales 3% this year. In light of the importance of our North America business, I'm going to spend a minute on the turnaround in the performance in our U.S. spirits business. Our fastest growing brands in U.S. spirits, Buchanan's, Crown Royal, Don Julio, and Bulleit, continue to deliver a strong performance. Crown Royal lapped the launch of the highly successful Regal Apple innovation in the second half, and both it and Crown Royal Deluxe grew. Deluxe has momentum with new campaigns, including one partnering with country musician Chris Young for fans to share tales of generosity on social media. We continue to innovate to meet the evolving preferences of today's whiskey consumer. In the fourth quarter, we released a limited summer-only Crown Royal Honey to capture incremental seasonal whiskey occasions. We also launched Cornerstone Blend, the first whiskey from the Noble Collection, a series of allocated annual releases highlighting the craftsmanship of Crown Royal's distillers and blenders. Our premium core spirits brands are the biggest part of our North America business, and returning these brands to growth was the biggest contributor to top-line improvement. Smirnoff is up 2%. We are continuing to focus on recruiting millennial consumers through the brand's inclusivity message, positioning the brand at the right price and providing standout packaging. Captain Morgan gained share in a declining rum category as we stepped up recruitment using our proven growth drivers of memorable, disruptive, fun activities in the on-trade, and we launched Cannon Blast to compete successfully in the shot occasion. In Scotch, Johnnie Walker was back in growth, driven by its reserve variants, and performance improved in Ketel One Vodka, Tanqueray, and Baileys. The key U.S. brand not shown on this slide is Ciroc. We saw a strong recovery in the second half, up 95% due to the launch of Ciroc Apple, which is one of the top innovations in U.S. spirits. This followed a decline in the first half when Ciroc was impacted by the move to the replenishment model. For the full year, Ciroc was down 7%. In fiscal 17, a new marketing campaign, including new digital content and the use of seasonal flavors and sampling, will enable wider recruitment, delivering the brand back to growth. Ivan will talk more about our outlook for U.S. spirits in fiscal 17 later. Turning to the other regions, Europe, Russia, and Turkey grew net sales 4%. Momentum continued in Europe, with Diageo gaining 30 basis points of share of overall spirits in Western Europe. Russia delivered net sales growth despite a decline in volume, and Turkey grew 6%, although the market slowed in the second half because of a 15% duty increase in January. In Africa, all markets contributed to growth except Nigeria, which was cycling the successful launch of Origin in the prior year, as well as facing increased competition in the category. Our East Africa, South Africa, and Africa regional markets businesses all saw improved momentum in the second half. In Latin America and Caribbean, net sales were up about 1%, with a weaker second half due to the unwind of advanced purchasing in the first half ahead of the December duty increase in Brazil. Double-digit growth continued in Mexico and Colombia, but our export channels suffered with the appreciation of the U.S. dollar. Asia-Pacific net sales grew 2%. We saw growth in Australia, Taiwan, and Southeast Asia, while Korea remained weak given the decline in the traditional on-trade and consumer shift to lower alcohol content products. Our China sales, excluding Shui Jing Fang, are a bit less than 1% of group sales and also declined. While the impact of anti-extravagance is easing, we continue to see some level of destocking by distributors. Despite this, we did improve our share position in the super premium Scotch segment. In India, we're making good progress, and net sales grew 5% despite some disruption in certain states. In fiscal 16, we relaunched 3 of our power brands in the prestige segment: Royal Challenge in the first half, and the core variant of McDowell's No. 1 and Signature in the second half. Royal Challenge volumes are up over 60% after this intervention, and Royal Challenge and McDowell's No. 1 are already gaining share. We have also continued to see strong share momentum in the premium Scotch portfolio of Black Dog, Black & White, and VAT 69, and gained in premium vodka led by Smirnoff. Johnnie Walker Red, Black, and Double Black have also gained share. All 6 global giants, Johnnie Walker, Smirnoff, Captain Morgan, Guinness, Baileys, and Tanqueray, were back in growth this year. Johnnie Walker grew 1%, with reserve brands up 10%. Smirnoff and Captain Morgan's improvement was driven by their performance in the U.S., with continued good growth in Europe. Guinness momentum continues. The brand is growing in Africa and in Great Britain and Ireland, driven by innovations such as Guinness Africa Special and from the Brewers Project, especially Hop House 13 in Great Britain and Ireland. As you saw in our press release this morning, the stronger growth of Guinness helped performance in our beer portfolio, with sales up 6% year over year. Baileys and Tanqueray both grew in their biggest markets, Europe and the US. Baileys refocused its activation behind proven growth drivers, such as sampling, and Tanqueray is benefiting from the buoyant gin category. Turning to category performance, Scotch improved significantly, moving from a 5% decline last year to a bit better than flat this year. This is still short of its potential, and Ivan will discuss our fiscal 17 plans later, including some great work coming through the evolution of our Johnnie Walker Keep Walking campaign. Vodka improved modestly, driven by Smirnoff growing 2% in the developed markets and 1% in emerging markets. Strong growth continued in North American whiskey, though at a slower pace as I described earlier. Indian-made whiskey grew 3%. This reflects the recent changes made to expand distribution and outlet coverage and the renovation of key brands. The performance of Captain Morgan and Baileys drove the turnaround in their respective categories. Gin accelerated thanks to Tanqueray's growth in Europe and the US. Tequila grew 8%, with strong growth of Don Julio in the US. Shui Jing Fang continues to do well, with year-on-year sales growth slower as Diageo cycled a technical 5 quarters from fiscal 15. Kasasha, a small proportion of our total business, declined given weaker consumer sentiment in Brazil. Turning to operating profit, our reported figures were negatively impacted by foreign exchange and disposals. On an organic basis, we were up 3.5% versus last year, delivering 19 basis points of operating margin expansion. North America, Europe, Russia, and Turkey, and Asia Pacific all had positive organic operating profit growth and margin expansion, while operating profit declined in Africa and the Latin American and Caribbean regions. This was attributable to the weakness in Nigeria, Brazil, and the export channel in Westlac, as I discussed earlier. Margin expansion was delivered by gross margin improvement, driven by the return to growth in U.S. spirits and significant gross margin improvement in Europe, up 100 basis points. In addition, efficiency gains in marketing offset increased marketing activity. Overheads increased as a result of the higher bonus and inflation. The cost of restructuring changes were offset by savings from our January 2014 Global Efficiency Program and increased gains from land sales this year. About 40 million pounds of restructuring costs were incurred. We expect that figure to be higher in fiscal 17 as we move to a more continuous approach to organizational efficiency and effectiveness. Again this year, the business has delivered significant marketing efficiencies. These have been achieved through optimizing digital partnerships, benchmarking our contracts to renegotiate better deals, and working smarter with our creative agencies. Our North American and European businesses have so far led the way on this journey, with more to be done globally through our productivity program. In North America, we have seen much of the innovation timing-related savings in the first half spent on launches in the second half, including Ciroc Apple and Smirnoff Ice Electric. In USL, marketing spend reduced following the end of the related party agreements, as we discussed at the first half. In China, we reduced spend on expensive promotion in the modern on-trade, given the current low returns on these programs, mainly behind Johnnie Walker. After adjusting for these 3 factors, marketing spend increased 6% year-on-year, ahead of our net sales growth. Free cash flow was £2.1 billion this year, an increase of £134 million. The working capital movement was caused by the comparison year-on-year. We saw a significant drop in operating working capital last year, followed by a modest increase this year, as the natural impact of top-line growth was partially offset by the continued gains we're making to improve working capital efficiency. Interest payments reduced with lower interest costs, as I shared earlier, and we had a benefit from the timing of payments year-on-year. Net CapEx was lower than last year following the completion of the Scotch expansion project and the new St. James Gate Brewery, and benefited from disposals. The weaker pound and continued growth of our business will lead to an increase in CapEx, so we expect to spend about £600 million in fiscal 17, and I expect disposal proceeds will be lower. Over the past couple of years, we have worked hard to focus our people on managing working capital every day of the year. As a result, our average working capital as a percent of net sales value has improved consistently, reflecting the strong capabilities that we've put in place across the business. I excluded India from the chart so I could show the 3-year trend, as we only began consolidating USL in July 2014. Excluding USL, our average working capital as a percent of NSV has improved from over 5% to less than 2.5% over the last 3 years. USL does run with significantly higher levels of working capital, driven in part by local regulations, and we're working just as hard there on improvement. When we look at Diageo with India, we still see about a 2-point improvement over last year. Closing net debt decreased by about £900 million, largely on receipt of disposal proceeds and our strong cash generation. This was partially offset by the impact of the weaker pound on our closing debt balance, as about 65% of our debt is denominated in US dollars. This significant reduction in net debt, modestly lower rates, and a lower hyperinflation charge reduced our net finance charges by £85 million. Key drivers of the lower interest rate were the reduction of debt in United Spirits, as well as the maturity of higher-rate Diageo bonds. For fiscal 17, I would expect our interest rate to be about 3.6%, reflecting the projected increase in U.S. LIBOR rates and lower use of commercial paper, given the full-year impact of receipt of the disposal proceeds. Other finance charges decreased £34 million, largely driven by a lower hyperinflation charge for Venezuela, as the result of the change that we made to the consolidation rate earlier this year. I would expect other finance charges to increase next year, with higher pension costs and the recognition of the increase in value of SICAPA. Our adjusted net debt to EBITDA ratio at the year end remained unchanged at 2.7 times. The reduction in average net debt was offset by the increase of about £900 million in post-employment liabilities, reflecting lower discount rates. We expect our cash flow delivery to remain strong and M&A activity to continue at a modest level. As a result, we expect net debt to decline in fiscal 17. Additionally, weaker sterling, which is already reflected in year-end net debt, should have a positive operating profit impact in fiscal 17, thereby increasing EBITDA. Both of these factors should play towards improving our leverage ratio. Right now, our leverage ratio is squarely within the 2.5 to 3 times range we target. As a result, we are not yet in a position of having excess capital to deploy. Please let me share with you how we see foreign exchange impacting our fiscal 17 results. Exchange was a headwind in fiscal 16, though to a lesser extent than past years. With the recent weakening of the pound, exchange is forecast to be a significant tailwind in fiscal 17. Using the current spot rates, exchange is forecasted to benefit net sales by £1.1 billion and operating profit by roughly £370 million. The weaker pound has the opposite impact on net debt, as I outlined earlier. This is forecast to result in higher net interest charges of £20 million. It will also impact CapEx, as I mentioned, given the level of our CapEx spend outside the UK. There are still a few variables around exchange in fiscal 17 which could affect this forecast, including any further impact of Brexit on the pound and the euro, continued volatility in emerging markets, and continued hedging of our US dollar and euro exposures. EPS before exceptionals was up 1% year on year. Adverse exchange, the impact of disposals, and a higher tax rate had an adverse impact. The increase in non-controlling interest was largely driven by the increased profit in United Spirits. These adverse impacts were more than offset by operating profit growth, higher associate income, and lower net finance charges, enabling the 1% growth in EPS. Our tax rate increased from 18.3% to 19%. Greater focus of tax by governments is exerting upward pressure on tax rates for all multinationals. Combined with foreign exchange, which increases our reported profit in higher tax rate jurisdictions, we expect our tax rate to be 21% for fiscal 17. The recommended final dividend is 36.6 pence per share, up 5% from the previous year, bringing the full-year dividend to 59.2 pence per share. Our goal is to rebuild dividend cover. That's the relative ratio of EPS to the dividend, to between 1.8 and 2.2 times. Dividend growth is expected to remain at a mid-single-digit rate to enable that recovery. As Ivan said earlier, we delivered our objectives for fiscal 16. As you can see, we improved against each of the efficient growth metrics that we use to measure progress towards our performance ambition. Our value creation measures also improved, although ROIC gains were held back by the negative foreign exchange impact on profit. Our total shareholder return performance was strong, up 17% versus up 2% last year. As we look at these value creation metrics, our goal is consistency, sustaining our improved performance and making more progress from here. Gains will continue to come from driving efficiency in every aspect of the business and across every expense line, reinvesting efficiently in growth, in CapEx, and in M&A, and managing our financing efficiently as well as our portfolio. I believe this consistent approach to growth, productivity, and cash will drive better value creation, and I would expect to deliver further progress against these measures in fiscal 17. In addition to continuing to execute our strategy, we have a few points of emphasis in fiscal 17. Growing our Scotch business. Scotch is at the heart of our business and contributes 25% of our top line. Fiscal 16 saw a significant turnaround in the performance of Scotch, and we're confident there is more. Continuing to strengthen the U.S. spirits business. It's our largest and most profitable market. It's also one of the fastest growing markets in the world, and one in which we have made changes, both in people and ways of working, to accelerate our performance. India is nearly a tenth of our net sales. Category growth is strong, and USL is now a business in good shape to grow share. The momentum we carry into fiscal 17 from fiscal 16 and our confidence that focus in these three areas can deliver a further improvement in performance underpins the guidance that we have given today for mid-single-digit top-line growth and 100 basis points of margin improvement for the 3 years ending fiscal 19. And now I'll hand you back to Ivan.
Thank you, Kathy. I started my presentation reminding you of our strategy, our 6 priorities, our goals, and the way we will measure progress. Kathy has covered 2 of the measures, so let me cover the other 2. First, credibility and trust. Alcohol has a positive role to play as part of a balanced lifestyle, and the trends we see support that consumers, particularly young adults, are drinking better, not more. I am very proud of our leadership in promoting responsible drinking, including the work we do on drink driving reduction. The consumer needs information to make responsible drinking choices, and we are providing more information on our key brands, starting with Johnnie Walker. While responsible enjoyment of alcohol is core to who we are also a global company, and we have a role to play ensuring the communities we are part of thrive. From local sourcing of material and services to support local economies, to training to improve the employment prospects of women and young people in disadvantaged communities. And as a global manufacturer, we are committed to protecting the environment. Earlier this month, we announced a 5-year international partnership with WaterAid. We've worked with them for over the last 15 years, so we know that our longer-term commitment can make an even bigger difference to communities where water is a scarce resource. That's why one of the performance figures I am most proud of this year is that our water use efficiency has improved 12%. The motivation of my co-workers is our fourth measure of progress towards our performance ambition. This year, nearly all of Diageo, 97% of us, took part in our values survey, and that proportion has increased steadily in each of the last 4 years. Our participation rate is 16 percentage points above our benchmark peer set. As this slide shows, during a time when we've been re-emphasizing delivery of growth, focus on productivity, and on cash conversion, our engagement levels have consistently improved with a 2-point gain each year. The strength of employee engagement is evidence that across Diageo, people share my view that change has built a stronger company that everyone is proud to be a part of. And we intend to make it even stronger. So let me now cover the 3 areas where we will dial up focus to drive further improvement in fiscal 17. Starting with Scotch. We have the widest Scotch portfolio in the industry, from affordable Scotch brands through premium core up to unique ultra-premium offerings. Fiscal 16 was a better year with significant improvement in performance. Our 2 largest Scotch brands demonstrate this. Buchanan's grew double-digit, and Johnnie Walker is back in growth, led by our reserve offerings up 10%. For fiscal 17, our strategy for Johnnie Walker is to recruit consumers through 4 pillars consistently and beautifully executed. First, telling inspiring stories. The Keep Walking campaign evolves around a constant truth that progress can be a force for good. In fiscal 17, we will tell stories about people whose positive attitudes and actions are bringing about a better future. We launched this new campaign with a story of courage and reconciliation from Colombia. We have put a link to the video at the end of this presentation. Take time to watch it. It's an awesome story. Second, we are scaling up liquid on lips, the most tangible way of recruiting consumers delivered in 2 activations. The Long Summer Serve, or Weekends Were Made for Whiskey, tackles any taste barrier consumers may have on Scotch through sampling. It anchors Johnnie Walker in a long mixed serve for the summer. And we will use mentoring, our most consistent growth driver. With the mobile mentoring units shown on the slide, we can scale up mentoring across all markets. But mentoring doesn't need to be in a physical space. This month, we launched digital Johnnie Walker mentoring to engage consumers in a totally new way, inviting them to pour a glass and taking them through exactly the same steps experienced in a physical mentoring session. The colors, the aromas, the taste, but at a very effective cost for Diageo. And third, gifting, which is a massive opportunity for Johnnie Walker. 2/3 of premium spirit drinkers in the UK have been given alcohol brands as a gift, and about 1/4 of spirits are bought as a gift. But gifting of spirits is still behind spend on other luxury goods. Limited edition packs, personalized engraving, and even something as simple as providing gift bags helps the consumer put Johnnie Walker on their gift list. Our 4th pillar is highlighting the skill of our blenders and the richness of our blends. Many people, especially millennials, are light category consumers. They enjoy discovery and seek out new experiences, and maybe for some, Johnnie Walker feels like a big brand. Blenders Batch will change that with small-scale experimental blends that showcase the skill and soul of the art of blending. Each year, the best of these experimental blends will be scaled up for a wider audience, ensuring consumers view Scotch as a vibrant and engaging category. And as consumers in emerging markets trade up, primary Scotch price points can sit between local mainstream spirits and premium core. Black & White, White Horse, and VAT 69 have the strong brand credentials needed to participate in this space. And Diageo has the scale and in-market presence to actively manage the cost base of these brands. So while the price points are lower than premium core Scotch, the margins are still favorable. In Mexico, for example, they have a powerful and effective strategy, communicating Black and White's strong credentials and heritage as part of the House of Buchanan's. Building on Buchanan's position as the strongest deluxe brand in Mexico, Black and White is the fastest growing whiskey brand in the market. And at the right price, with a 30% premium to its key competitor, volume has grown from 65,000 cases in fiscal 13 to nearly 400,000 cases this year. In the US, the consumer is open to exploring new tastes and is looking for heritage, authenticity, and craftsmanship. This is a big opportunity for Scotch. The strong multicultural dynamic of the US also supports Scotch growth, as Hispanic and Asian consumers have a strong affinity with Scotch, given the strength of our brands in Latin America and Asia. In a premiumizing category, we can lead the growth. Which brings me neatly to the US, where we now have momentum. In fiscal 16, we made 3 changes to our US spirits business to drive faster growth. We have a new management team for the whole of North America. We have put in place new agreements with our biggest distributors, which build on the most comprehensive distribution network in US spirits. Diageo and its distributors are committed to creating the most consumer-focused sales and distribution system in US spirits, ensuring that Diageo's brands have the most effective commercial executions and the most impactful sales activations. And we have a transformed marketing organization focused on the growth engines of Release, North American Whiskey, Reserve, and Scotch, a cutting-edge, consumer-focused approach to brand building. These changes are already having an impact. Smirnoff is in a competitive segment, and we adjusted price to improve competitiveness. New marketing is now having more impact with millennial consumers, as Smirnoff is always on. It is relevant to millennial consumers, whether in culture, for example, our involvement with electronic dance music, or making life easier with easy cocktail recipes or enticing bar recommendations. Smirnoff innovation meets consumer needs, with Smirnoff Sourced, for example, providing authentic fruit flavors with real fruit juice and gluten-free. With improved price positioning, improved brand positioning, and more focused innovation, Smirnoff grew 2% in fiscal 16 against a decline of 4% last year. Captain Morgan is also back in growth with a new vibrancy. It is one of the most distinctly recognized brands in spirits, and Captain & Coke is still a top 5 branded bar call. We have refocused marketing to recruit entry-level spirits drinkers by revitalizing Original Spice Rum with memorable, disruptive, and fun activity. We've increased focus on multicultural consumers, and Cannon Blast is bringing new consumers into the brand through the shot occasion. In this rather unusual election year in the US, the captain is championing the cause for a constitutional amendment to allow under 35s run for president. Captain Morgan is growing share, and this gives me confidence these are the right programs. So in fiscal 17, we will invest more behind these growth drivers with a digitally led plan to drive even more brand awareness. Bringing that all together, how will we build on this momentum in fiscal 17? We will complete the work we have done to create optimal price positions. We will widen our reach to the growing number of multicultural consumers. We will increase marketing effectiveness as we build an integrated approach across digital and traditional platforms, and as we leverage our marketing messages through in-outlet activation using our activation army. We will be even more disciplined in how we measure and evaluate our brand spend. We will use time-limited innovations to meet specific consumer opportunities, and we will focus on productivity to continue to expand margin. This will continue the momentum we have in US spirits with volume growth, continued mix improvement, and margin expansion. Our third area of focus for fiscal 17 is India, where consumer dynamics are fueling premiumization. In fact, we view the market as three Indias, with consumers across all income levels on a journey through our brands. Given its brand range across categories and price points, USL is well placed to capture the growth in this market. In less than a year of full distribution, we are already gaining share in Johnnie Walker and Smirnoff. We are renovating our key brands, beginning with Royal Challenge and McDowell's, followed by Signature and Antiquity. We are strengthening our distribution with around 20% of outlets already at perfect store level. We are driving out costs, moving to lighter weight glass, and standardizing procurement. Through our corporate citizenship agenda, USL leads on responsible drinking, engaging with regulators to influence public policy. In addition, we have local programs in place to positively impact our communities. Our business in India is stronger this year, and it will be an important driver of growth for Diageo. Those are the three areas of particular emphasis in fiscal 17, but our 6 priorities remain key to achieving our performance ambition. I've given you examples of how we will keep our premium core brands vibrant and talked about increasing growth in mainstream spirits in India. So I'm now going to cover the remaining 4 priorities. Diageo Reserve is a great example of growth from sustained, disciplined execution. In 2011, we transformed our route to consumer for luxury brands with disciplined execution against 3 growth drivers: mental availability, physical availability, and recruitment. That built the Reserve business to the scale it has today, built off a single business model. And as we shared with you in November, we are going to bring a greater definition to our luxury brands and segment the business into 3 areas: mass, core luxury, and prestige. This will enable us to tailor investment by brand and segment, and over the next 5 years, I am confident this will unlock greater growth. The biggest change is in how we scale up distribution and physical availability of our mass luxury brands by using our broader sales force. In Great Britain, for example, using our existing on-trade sales force, we've almost doubled the distribution for Ciroc, Bullet Bourbon, and Tanqueray 10 in fiscal 16. And Ciroc is now the #1 premium vodka in Great Britain, overtaking the long incumbent leader. In innovation, we have set out to be at the cutting edge of consumer trends. It's not just about our brand and liquid innovations, it's also about where consumers drink, how they engage with outlets and brands, and how we build the best incubator for new brands. You may not have heard about third space, but I'm sure you've been there. Those consumer occasions which are not in traditional on-trade or at-home occasions. Urban space is at a premium and cities are congested. Gone are the days of formal venues with a single purpose. We're increasingly in a world where venues are constantly adapted and changed for the next event. Imagine if there were no specific bars, just places that transformed into social spaces when needed. Pop-up bars, markets, festivals, restaurants, shops, and offices become the venues consumers use. From formal events such as weddings through to informal street parties, in Brazil, for example, where the third space is already over 3% of net sales and expected to grow double-digit. Third space does present logistical challenges, but we intend to lead here, ensuring our brands take full advantage of this cultural phenomenon. Our Tech Ventures group is about more than liquid and packaging technology. The future disruptors in the industry are out there, and our Tech Ventures group can identify and rapidly engage with them. We have a number of startups we're working with. Currently, they're mostly based in the US and the UK, but some of these will have global applications. They range from on-demand delivery, including Drizzly in the US, subscription services, including one focused on our Scotch portfolio, and restaurant delivery such as Deliveroo here in the UK. We've also invested in an app called Reserve, which allows consumers to book an evening out. This allows us to influence what they're drinking in the on-trade. It gives us access to valuable data about consumers and outlets. In China, we are working with Tencent and Alibaba on really cutting-edge technology. This is a fast-moving world, and we intend to maximize the opportunities it gives us. Digital Ventures is our brand incubator. It has already made 10 investments, of which the most recent is our investment in Seedlip. This is, as the entrepreneur behind the brand says, the solution to the problem of what to drink when you're not drinking. Non-alcoholic, it has 2 variants designed to be drunk in the same way as a traditional spirit, in a cocktail, with a mixer, or on the rocks. This is an exciting innovation, potentially creating a new category, and we are there from the start. Route to consumer has been an area of major focus for 3 years, but it's still an area of opportunity. Since we started, we have increased outlet coverage by 350,000 outlets, making 2 million more sales calls every year, and we've reduced finished goods inventory. This is the result of a standardized way of working across all markets, which is based on 4 elements. First, each customer has a plan, and their performance is measured against it. Second, specific execution standards have been set by type of outlet. Third, internal incentive schemes are based on the metrics which drive sales. And fourth, each market has a scorecard for their route to consumer objectives, and this is reviewed by the executive team. In Brazil, despite the challenges of the economy, the team have increased the number of outlets stocking our brands and increased the number of outlets which meet all of our execution standards. In regional supermarkets, for example, 10% of outlets now meet our execution standards. And in that 10%, net sales growth is over 30% against an average of 4% growth for the channel. This standardized way of working drives growth because it ensures our brands are available in the most dynamic outlets and ensures our brands show up in the most attractive and appealing way. We have a great example of how this is being done in Ghana, but rather than talk you through it, I'd invite you to watch a really compelling short video. The link to it is at the end of the presentation. Moving on to productivity. We shared our plan on productivity with you at the conference, so let me update you on where we are. Our commitment is unchanged. £500 million of productivity savings over the next 3 years. 2/3 will be reinvested to accelerate growth, and we will improve operating margins by 100 basis points over the same 3-year period. It will be delivered in 5 areas. The first pillar is net revenue management. We believe we can access significant value in headline pricing, the effectiveness of our trade investment, and promotional spend. We're working on our systems, processes, and capabilities in fiscal 17 to enable net revenue management to be a significant contributor to productivity from fiscal 18. Marketing efficiency contributed to our fiscal 16 performance, as you saw in Kathy's presentation. And this focus is set to continue. From fiscal 17, we will increase efficiency as agency costs and point of sale spend will be managed through global procurement. But of even greater longer-term importance is the work we're doing to make our marketing more effective. Diageo has marketing flair. Our teams create great marketing campaigns to drive the growth of our brands. But we think we can do even better by injecting rigor into the mix. The Diageo way of brand building has been our flagship marketing training program for over 15 years. It has continually evolved and as a result is regarded as best in class. In fiscal 17, we're transforming the program again to ensure it remains at the cutting edge of marketing thinking and building in the latest technology around measurement and evaluation. We believe this will transform the quality and effectiveness of brand building to drive growth. Our productivity goals in product supply are geared at reducing complexity to expand gross margin. So marketing and supply work together to ensure that the unique character of our brands is preserved as we standardize production through tramlines. Tramlining reduces cost in a way which does not diminish consumer value. We do this by benchmarking the optimum cost of all elements of a product to its sales value and to competitive benchmarks. A good example of this on existing brands is Johnnie Walker Platinum, where we've identified opportunities to make our cost more competitive on the gift box and bottle. And on Gordon's, where the design of a new bottle for the UK and export markets has created a better-looking, more impactful bottle on the shelf, which is lighter and cheaper to produce. This standardize and simplify philosophy also applies to the changes we are making to embed productivity. We are building capability for sustained ongoing productivity, do more with less. Centralizing resources and making better use of shared services will allow our markets to be totally focused on execution and driving growth. As Kathy said, the cost of making these changes to our business structures will be funded by productivity savings, creating a virtuous circle. We have deployed a zero-based budgeting approach for our indirect costs, and external benchmarking shows this is one of the best-in-class ZBB methodologies. We have a bottom-up activity plan for all of our indirect spend, challenged by cost champions for each type of cost, and we measure performance by month against this plan. The ZBB process has identified significant cost reduction opportunities. Some reductions are straightforward, for example, rescheduling events to run adjacent to each other in order to reduce travel costs, and leveraging technology to reduce face-to-face internal meetings. Some reductions are very creative. For example, our legal team in South Africa now have a preferred supplier list of upcoming lawyers willing to take on smaller, non-critical assignments at reduced fees to enhance their CVs. Key to identifying these cost savings has been the transparency we now have across all categories of spend. And finally, I would like to address the outcome of the UK's EU referendum. It is important that the UK continues to benefit from open access to the EU as well as favourable international trade agreements. We're therefore working closely with government and our industry bodies to ensure these concerns are reflected in the transition process, and we welcome the formation of a specialist international trade department. I'm confident that despite the current economic and political uncertainty, Diageo is well placed to emerge from this situation without significant disruption. Before we close, I want to make a few key points. We have a clear strategy delivered through our 6 priorities and a clear goal with measures in place to ensure we achieve it. Our results in fiscal 16 were a good set of results, and they delivered on our specific goals for the year, and we gained ground against our performance ambition. We demonstrated the strength of our execution, and we finished the year with momentum. The momentum we carry into fiscal 17 from fiscal 16 and our stepped-up focus on US spirits, Scotch, and India will lead to a further improvement in performance. This underpins my confidence in the guidance we have given today for mid-single-digit top-line growth and delivery of 100 basis points of margin improvement in the 3 years ending fiscal 19. Thank you.